Good afternoon, everyone. My name is Nikhil. I work for Zerodha, and today uh, we'll be hosting this talk on ELSS funds by Mr. Mahesh Patil, who's the co-CIO of Birla Sunlife, the mutual fund AMC or the asset management company. Right? He heads the entire equity investments for Birla Sunlife, and now I'll be giving over control of the mic to Mr. Mahesh. Right?
On
Mahesh can get started. Good afternoon, Mahesh.
Yeah, good afternoon.
So, Mahesh, our viewers would be basically interested to know how to invest in ELSS funds, right? So, if you could get started on the same, that'd be great.
Yeah. Yeah, so before we talk about investing into ELSS funds as a category, let me just take you, our investors, okay, through our brief outlook on the market. Because when you're investing into a fund, it's also important to know how the market will do, how the equity markets in general will do going forward. So recently, we came with our annual outlook for 2017. I will take you through some of the key points and share our views on that. So before we move into 2016, if you look at last year, was a pretty historic year for India in terms of big reforms which happened last year. Most important was the passage of the GST bill with a complete consensus in the parliament. I mean, this has been now on the table for the last 10 years or so, which has paved the way for reforms in the indirect taxes. We've also seen the various other bills like the real estate regulatory bill, which was passed, okay, and the bankruptcy bill, which was passed, which will help the banks in terms of restructuring the bad loans and proper recovery of that going forward, which is also very important at this point in time when we have seen huge NPAs in the banking system. And the Seventh Pay Commission was also implemented pretty well and on most importantly on time and compared to the earlier years. And the big event last year was the demonetization of high value currency notes, which saw again 86% of the currency in circulation, which was taken out, which is again nowhere in the world we have seen this kind of a demonetization, this size of a scale, and the impact of that also, we have seen the impact of demonetization play out. I'll talk about it later. But clearly, I think it shows that the government is is ready to take bold decisions, okay, wherever it matters, and pursue on its agenda in terms of reforms, providing a clean and transparent government. Again, on the global front, we saw big events like the elections, okay, which dominated both in Brexit, where we saw the Brexit vote, which was again a kind of a non-consensus kind of a thing. People didn't expect that, and we saw as a result of that sharp depreciation of the pound. But the market reaction post the event surprised everybody. It really brushed aside the risks, okay, which were there, which a lot of the people were forecasting because of Brexit, and markets continued their rally globally. Even when during the US presidential elections, when Donald Trump came to power, again, that was a kind of a surprise by the market. And many people were expecting that because that it could lead to some turmoil in the market. But after that, we have seen a good rally in the S&P globally. As a consequence of that and the policies of the Trump government, the expectation is that US will go into for a major capex. It will see its growth kind of a revive, and there are some concerns, also apprehensions about US trying to really go away from the inclusive policy of growth and focusing more on its own domestic growth and putting some kind of conditions in terms of border tax or laws on immigration. So that has caught the world slightly on the upside, but we've seen the dollar has strengthened quite a bit in the interim. US Treasury bill yields have gone up, and that has led to some outflow from emerging markets. But more recently, after Donald Trump actually assumed office, I think people realize that a lot of the policies, what he's talking about, is difficult to really implement some of those. and the dollar index, which was showing very good strength, has kind of weakened, and even US Treasury yields, which had strengthened, have kind of eased off. So I think the outlook, if this remains, then the outflows, what we've seen from our markets, FI outflows, that could start to reverse, and you could see inflows. In fact, in the last couple of weeks, we have seen FI flows have been turning a bit positive. So I think on the global front, US will look like to be a very growth outlook is likely to improve this year, and that will also help global growth to really pick up. Last year, again, we saw a big round pullback in commodities, both crude and metals, both put together. Again, a big event was the after 9 years, we saw the OPEC coming together and agreeing for production cuts and paving the way for crude to bounce above $50. But I think our view is that crude should not go above $65 because a global demand is still pretty weak, and at around $50-$55, you will see shale gas coming in a big way in the market. So that's the break-even point for US shale gas, and that will really augment the supply. So I think crude should remain between, say, $50-$65 in that range, which is not so bad for India. We should be able to manage that level of crude, even in the budget also this time around. The government has stated that they have made adequate provisions in terms of subsidy to take care of crude up to $60 or so. Metals have bounced back pretty sharply from the lows of 2016. Again, the two reasons for that: one is that China, where there was concern about a hard landing in terms of growth, has kind of stabilized. The growth outlook there looks to be pretty okay now after the central banks have again pumped in liquidity, and the banks have started to give credit back to the infrastructure sector. So that's helped. And also now recently talks about US kind of going in for a fiscal stimulus. So globally, I think now a lot of the central banks, including US and Japan, are talking about a fiscal stimulus to prop up growth. And that would probably lead to better, and also the fact that US planning a kind of $1 trillion investment in its infrastructure to really scale it up. So that should really give better demand for commodities. And we've seen a good rally across aluminium, zinc, and other commodities. So overall, last year, I think we've seen globally, we've seen the interest rates were kind of below zero or negative interest rates. At one point in time, there were 1/3 of the global bonds which were trading at zero or negative interest rates. So that is now turned around with the central banks globally now talking about a kind of fiscal stimulus, and we've seen interest rates kind of moving up a bit on the global front. In India specifically, if you look at clearly the government, especially post demonetization, there is been a need to really prop up growth. I mean, our economy was kind of looking to improve in the month of October with good monsoons, which were bad for the last 2 years, previous 2 years, as we know. The rural economy was coming back in good shape. Interest rates were also coming down, so that was also helping. But demonetization put a brake to that growth and temporarily. So it was imperative that the government come up with incentives. So, and we saw partly in the budget, there was a lot of focus in terms of trying to revive the rural demand, and we've seen that housing as a sector, which has been impacted because of a slowdown, government trying to give a big push to that, especially through the affordable housing route, giving a lot of incentives in terms of interest rate subvention and extending. I mean, the whole norms for affordable housing in terms of the size of the house, also the area under consideration was increased by around 30% or so. So I think that's an area which clearly has been giving a good push. Also, the SME sector, small and medium enterprises, which have been impacted because of demonetization, and a lot of workforce is there in that sector. That also has been given some support by the government in terms of uh, first, reducing the tax rate from 30% to 25% for companies with turnover of around 50 crores or so, and also providing a credit guarantee scheme under the banks who are lending to this sector. So that's one area where clearly we're seeing infrastructure continues to remain pushed, especially in areas like roads, railways, and metro projects, where we've seen a good allocation continue in this budget. And the government has also tried to really rationalize some of the taxes to ensure that there's a better compliance. And post demonetization, we think that the focus of the government is to really get widen the whole tax net and get a lot of individuals to pay taxes. And there have been some incentives, okay, which have been given, especially at the lower end, where we've seen that the tax rate for individual incomes from 2.5 lakhs to 5 lakhs has been brought down from 10% to 5%. So I think demonetization has clearly helped in terms of formalization of the economy, and and a lot of money will remain into the banking system, and that money will find its way to come back into the economy in a more productive way, and where the multiplier effect will be much better. So we think that the demonetization, anyways, I think the normalcy is now coming back, and it's coming pretty fast and soon than what we were expecting earlier. So while the whole money has not come back into the system by way of cash, but as we stand today, we see that availability of cash is now not an issue. There is some impact because of wealth impact, which is there, which can lead to some recovery. But I think a quarter down the line, we should see most of the sectors where the impact was felt should really come back to normalcy. So clearly, I think the growth is something which we think would again come back. Uh, the the monsoons have been good, so the rural economy is also now picking up. The sowing has been pretty good even for uh, the Rabi season. So I think the growth destruction which has happened because of demonetization should again come back on track as we move forward, say in next couple of years. Another big reform which we still awaited is the GST. I think the likely implementation of GST looks to be in the month of July, and a lot of work has gone into it now. The government is looking at a four-tiered tax structure to accommodate various sectors into the various slabs they have been talking about. And if you look at in India, there is various sectors where the unorganized is a larger share of the overall uh, of the market, especially in food services, apparel, jewelry, logistics, sanitary ware, footwear, where there's a huge amount of unorganized sector. The GST will clearly mean that the organized players, especially the companies which are listed, should be able to in a better advantage, because a lot of the unorganized sector was probably not paying taxes end to end, and with GST implementation and with stricter control, it will find it difficult for the unorganized sector to evade the input tax. So I think GST will mark another shift in the economy where the organized players will take incremental market share, and that should benefit a lot of the companies in the listed space. But the transition of GST would also mean some readjustment which would happen because of destocking, and also companies trying to get familiarity with the process, which might lead to slight disruption in probably one quarter leading to the GST and a quarter after that. So again, that will also be a kind of a transitory phase, just like demonetization was a transitory phase. But you will emerge out of that with a system which is much more efficient, which will reduce a lot of logistics cost, and will help to really a lot of companies could see better boost to their earnings in the coming years. Again, the interest rates cut have been steady. We have had now almost like 1.75 basis 1.75% rate cut in interest rates by the RBI in the last 1.5 years. Again, driven by sustainable low inflation. So that is likely to help the corporate sector. But more importantly, the transmission of the rates by the banks, okay, to cut down their rates to the corporates has now gathered momentum. And with a post demonetization, with the huge liquidity which has come into the banking system, the banks sharply cut recently their MCLR rate, okay, and the base rate. So the transmission of the RBI rate cuts is not happening much, almost to a large extent, which will benefit companies in terms of reducing the interest cost. If you look at the Sensex companies, then every 1% decrease in interest rates can increase the IPS by around 2.8% or so. So the full impact of the lower interest rates would be seen by the corporates in FY18 numbers. So overall, India's macro situation has continues to remain very favorable. Our CPI, the inflation, is now touching around 4.3, 4.5 or so, and we expect it to remain at around that level over the next 1 year. And uh, overall current account deficit is also pretty reasonable, despite the increase in oil prices, and oil imports have gone up, but current account is still manageable at around 1%. Again, gold imports have come down pretty sharply last year, so that has helped. So overall, the macro situation of WPI, current account deficit, uh, remains fairly under comfortable range, and our rupee also has been very, very stable compared to the other global currencies. We have seen a huge amount of volatility in not only the developed market currencies like the pound or the yen, uh, uh, and more so in some of the emerging market currencies. But Indian currency has been the least volatile in the last 3 years or so. So that shows our strength and the way the Reserve Bank has been able to manage our the overall macro situation. The liquidity continues to remain very strong, and that's been one of the reasons for the markets doing reasonably well, despite some near-term headwinds which we saw because of demonetization and slight slowdown in growth. The the domestic investors into the secondary markets, and this thing has, especially through mutual funds, has seen a good turnaround in the last 2 years. We have seen strong inflows into domestic institutions from retail as well as HNI, and partly we think this is a more structural trend where financial savings are increasing as a percentage of total savings of the household, and that again is driven by lower inflation, better awareness, a lot of drive which the SEBI and AMFI is doing in terms of investor education to channelize savings into financial assets, especially into mutual funds, has seen a good response. And also the curb on black money has helped for people to move from physical assets, where a lot of the black money cash transactions is to go to more towards financial assets. And also the fact that the other physical assets like gold, real estate, the outlook there is not that great. So this year, currently, we are getting as a mutual fund industry around close to around 4,500 crores on a monthly basis by way of SIP, that is the systematic investment plan, and that's the steady inflow. I think we expect the inflow of domestic investors into mutual funds to sustain, and that will be a big structural force for the markets, uh, especially at a time when FI flows have been kind of, we've seen last year FI flows were a bit tepid, but now with FI flows also, if they start to improve, because last year we have seen the emerging markets haven't done that great. A lot of money went out of emerging markets. That can start to normalize in this year. So there'll be a strong liquidity from domestic as well as from foreign portfolio flows, which will be very supportive for the market. Again, the FDI has inflow into India, which is the real long-term money, has been very strong, and this has been aided by the various sectors which the government has opened from FDI in the last couple of years, be it real estate, retail, defense, railways, and India has got record FDI inflows touching almost like $40 billion, and that's again provides a good stability to our BOP, balance of payment, and our overall forex reserves have been very healthy at a time where globally we've seen a lot of the emerging markets, including China, where the forex reserves continue to be run down. And so I think India, while growth rate is still not really improved dramatically, and demonetization has also taken its hit, but India continues to remain a very strong growth from a global perspective, one of the large economies which would have the highest growth, even better than China, and that would really continue to attract foreign investors to invest into our markets. So just to summarize on the market outlook, I would say that while demonetization has been an effort by the government to continuously weed out black money, you could see more measures by the government to tackle black money, where I think there is a clear resolve by the government to tackle that. But I think the impact of this is temporary, and what we had budgeted earlier, I think looking at the quarterly number results which have come in, we think that the impact to earnings because of demonetization for this year would be just around 2 to 3 percentage points for Nifty earnings. Next year, we expect the corporate earnings growth to again bounce back pretty strongly. This year, the growth would be probably around 9 to 10% for Nifty. Next year, we're looking at a growth of 18%, and this will be driven by sectors like auto sector, like the banking and financial services sector, the oil and gas sector, the pharma sector, the consumer durables, and cement, other sectors, okay, which will report a very strong growth, and that would really try to sustain the market going forward. The government, the GST and other reforms, okay, which will come in, will only help to support and to sustain this growth from a longer term perspective. And I think the government also has been in terms of the budget and other measures, okay, which are there in terms of trying to improve the basic infrastructure, would ensure that India is on a path for a reasonably high growth, say around 7.5%, 8%, okay, for the next few years. And that's the bedrock for the market to really outperform or to give returns in line with the earnings growth. We think that earnings growth trajectory over the next 3 years can be around 13 to 15% or so, which is what I think the market should broadly return, because the valuations are pretty reasonable. They are slightly expensive than the long-term average, but we should understand that at this point in time, the earnings are also pretty depressed. Okay, and also interest rates coming down. We expect another 50 basis point rate cut over the next 9 months. So you are a scenario where rates are going down, the risk-free rate as it moves lower, the markets can support a higher valuation with the same level of earnings. And for investors also looking to park their investments, as interest rates go down, say currently your 1-year fixed deposit rate would be around 6.75 or so. As it goes down below 6%, which we think is quite possibility looking at the huge liquidity which is there in the banking system, and for the rate cuts, I think investors will look at other alternatives to really park that money into higher yielding assets. And equities would be a good option for somebody to look at double-digit returns in the over the next 3 to 5 years time frame. So that's on the market outlook. We think that the market should do fairly well for long-term investors, okay, to get say returns over the next 3 years around 12 to 15% in that range, and one should continue to invest market at various levels. It will remain volatile. I mean, this year again there are a lot of global events, okay, which could probably impact the market, especially Brexit. I think the second derivative impact of that is something which could come in. Europe is also going in for major elections this year, especially in Germany, in Netherlands, in Italy, where the outcomes can lead to some kind of a impact on the whole European Union itself, which can lead to some uncertainty. And this year we've got two rate hikes coming in by the Fed. So all these things are events which can lead to some mild corrections in the market, but I think those corrections should be used to buy into the market. That's what our view is. On the budget, I mean, I think just few quick takeaways from our side is that we find the whole budget this time around has been very prudent by the finance minister, really at a difficult time to rebalance between growth and trying to at the same time uh, contain the fiscal deficit, sticking to the 3.2% fiscal deficit target, and also committing to really bring down fiscal deficit over the next 3 years. More importantly, targeting to bring down the overall debt to GDP to a more manageable level over the next 5 years. And a lot of the assumptions in the budget seem to be very credible. Both the assumptions in terms of the on the revenue side as well as on the expenditure side are very credible. And the key feature has been try to maintain the subsidy level flat. So the last 3 years, we've seen the subsidy level has been more or less flat and seen no significant increase. The government has been able to reduce the oil and gas subsidy because of the reforms what it has done. Even the first fertilizer subsidy also has been kept at manageable levels. So now with a government looking at direct cash transfer or a DBT subsidy directly, I think that would also be contained. A lot of leakages which were there because of the way subsidy was administered would be taken care of. And the budget also focus on trying to really get a better compliance focus, transparency in the political funding, which the government has taken a big move, okay, which was a source for black money generation. Also trying to widen the tax base, lowering taxes both for SME sector and for the at the lower end to get more people in the overall tax bracket, which will, in the longer term, help the government to increase the tax to GDP ratio, which is pretty low at this point in time. And also to bridge the gaps which were there, certain gaps which were there in terms of taxation, especially for foreign portfolio investors on uh, 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 indirect tax transfers. So they've given a clarification on that and tried to resolve the uncertainty around there. And so all these issues, I think, have been addressed by the budget. It's a very clean and a clear budget focused on rural, agri, and infrastructure. These are the three pillars for growth which the government has identified going forward. So I think with the budget now behind us, with demonetization behind us, I think the markets, bulk of the risks are kind of behind us, except save for some on the global front. We have elections in the next month in UP, which our market will look at it, not such a key impact, I think, on the market as such. But I think we are set at a place, especially on the equity side, with lower interest rates uh, and improving growth outlook to get in a phase where investors can look at returns which are better than any other asset class. So for investor looking to invest into equity, I think we thought we'll focus on the tax saving scheme, because this is the season for people to really do their tax planning and looking at what are the options to invest into so that they can not only save tax but also look at better returns in the longer term. So what if an investment can give you not only the benefits of returns which equity gives, which you all know equities have given good long-term returns in somewhere in the mid-teens, as well as superior tax saving compared to any other instruments, and on a regular yearly basis, okay, giving tax benefits. So the ELSS, or the equity-linked savings schemes, which is an open-ended equity mutual fund, offers that twin advantage of exemptions under ATC, of the Income Tax Act. The way the deduction works is that under the supposing if you had total taxable income was around 7 lakhs, if you had uh, as per a normal tax without any kind of a tax saving scheme, you would have had a tax of total tax payout would have been 65,000. But if you invested that money into say a fund like ELSS, which maximum you could invest up to is around 1,50,000, you could have a saving of around 30,000 rupees or so. And why would you look at this as an investment compared to any other? Because under the scheme, there are other options for you to also invest into. So, the ELSS, the lock-in period is low. It's only 3 years compared to traditional tax-saving instruments like bank FDs or public PPF, okay, where you have to put in money for 15 years, okay, before you can withdraw without any taxation. Also, since equity dividends which are paid out are tax-free, any dividends which are declared by this fund on a regular basis, which also people look at as a kind of a regular income, those are completely tax-free. So normally we have seen typically the dividend payouts vary between around say around 6% to around 10% of the NAV is what historically what we have seen. And uh, and after the lock-in period gets over, after 3 years, whatever money which you withdraw, okay, if there is a need to do that, they are totally exempt from tax in line with what equity taxation is. And all above all, I think most importantly, the potential to generate higher returns. As we've seen that equities, since underlying investment into equities is into equities, we expect, looking at our outlook also, what we have for equities, and traditionally what equities are given, I think we should get higher returns than some of the other tax saving instruments. So take you through the returns, what the equities have given vis-a-vis other tax saving instruments like the PPF and the FDs. So if you had invested annually 70,000 rupees, okay, since March 96, uh, and if you're invested that into the market, that amount would have grown at a compounded rate of 13.5%, and the value of that would have been 69 lakhs today, compared to around 36 to 37 lakhs in PPF and FD. And if you had invested that, instead of just putting the money in a Nifty or the broader market index, but in an actively managed fund like Birla's Tax Relief 96, which is now completed more than 20 years. So then that same investment of annual investment of 70,000 rupees would today have become 2.53 crores. That's an amazing large amount, and that shows the power of compounding, because this would have compounded at a return of 23.65%, and if you compare that the returns from the market, okay, which were anyways better than the FD, I think it's like more than 3 times, right? So that's what the fund active fund management can offer to investors from the longer term compounding power of active fund management. So just to take you through the key attributes of the Birla Sunlife Tax Relief Fund, okay, which fits into this category. Our fund is a large cap oriented fund, which is essentially a multi-cap fund. So it follows a flexi cap strategy, which you can invest into large cap as well as mid caps, depending on the outlook of whether the mid caps offer a better value or large caps. The mix of mid caps and large caps vary accordingly. And it's pretty well diversified, investing into high quality stocks, roughly around 50 stocks spread across multiple sectors. The philosophy here is to buy into good stocks, which we think can deliver good returns from a longer term perspective, companies which have got very strong balance sheet, superior management. These are the kind of filters which we look at before investing into the stock. And this helps especially at times when there is a lot of volatility in the market, or there is a deep correction. The fund has been able to, because of the high quality nature, has been able to withstand the volatility much better. And we've been, because of our strong research capabilities, we have a very large research team of analysts internally who are evaluating stocks. We have been able to really identify very good stock winning ideas in the portfolios with a lot of emphasis on bottom-up stock picking to generate alpha. The fund has demonstrated its ability to identify stocks which have delivered superior returns to generate good alpha in the last 3 years and also over the longer term time frame, and which is adequately reflected in the fund returns. If you look at from a 2-year perspective or a 3-year, 5-year or 10-year perspective, the fund has been consistently beating the benchmark, which is S&P BSE 200 index, by a fair deal of margin. In fact, in the last 3 years, the fund has beaten the benchmark by more than 10 percentage point. But even from a longer term perspective, I think you can expect the fund to beat the benchmark by around 300 to 400 basis point, which is a fairly good excess return over the market, which the investors can get by investing in this fund. So I think I would urge investors to really do their tax planning doing now, start looking at it. Uh, Put a slightly larger allocation towards equities if you are especially early in your cycle. If you are a young investor and have a long time frame for you to really withdraw your savings, then larger allocations to equities makes a lot of sense. And tax savings fund, Birla Sunlife Tax Relief Fund, 96 fund should be your kind of a preferred route, okay, to do that saving. So I think that's it, what I had to share with you through this uh, webinar and through this session. We can now throw open the floor for Q&As. Any questions you have on the markets or about the funds, I'll happy to take that. Thank you.
Uh, Hi, Mahesh. So, thank you for that session. Now, we also have a few questions from a few of our users, right? So,
Yes, sure.
yeah. So the questions are like this, right? These are all recurring questions that we picked out of the chat. So, firstly, people want to know the difference between a regular mutual fund and an ELSS fund. So, if you could please explain to them once more what this is all about, so that would be great.
Yeah, so the ELSS fund, in terms of its management style and this thing, is similar to regular, say, diversified equity fund. There's a slight difference only because since these funds over here are available for a 3-year time frame, so it's a kind of a 3-year lock-in which investors come in. So the churn is much lower from the portfolio side. So that gives the fund manager to take a slightly longer term perspective when he is investing into a stock, and take a 3-year view. So that helps to identify companies which are slightly more differentiated, where probably, from a 1-year perspective, they might not look that great, but when you take a longer term view, especially good high quality companies which are always reasonably priced in the market, but when you take a longer term view, because of their superior earnings capability or superior franchise, they can continue to deliver better earnings and returns. The fund manager can take that into consideration and do his stock picking. So that's one advantage which normally we see the fund manager has in this kind of a scheme, and that is also reflected in the lower portfolio turnover for this kind of a fund, which is like turnover for the tax relief 96 fund would be almost 1/3 or 1/4 that what you would see in some of the other diversified mutual funds. So that's one from the fund management style. Apart from that, from the investor perspective, obviously there is a lock-in period over there, which is not there in other funds. And the lock-in benefits is there because there is tax benefit which is there. So under the section 80C, you can up to 1,50,000 investment in these funds they can be available for deduction from their income. So that is the added benefit, okay, which the tax relief fund offers compared to a normal diversified equity fund. So that helps you to save if you take the full benefit. Uh, if you are in the high income tax bracket, then you can get a sizable amount of saving while you're doing your tax planning for that particular year.
Right, right. Okay, thank you. Another question that most people have is, I mean, this is, I guess, one of the most important questions and common questions out there. What kind of returns can you expect in ELSS funds?
So the returns in the fund are direct correlation to the market returns because it's a fairly 100% investing into equities. So the underlying market returns will be the key driver for the returns. So our outlook on the market, as I mentioned in our earlier market outlook, is that going forward, say if you take a 3-year view, we are at a phase where the economy is likely growth is likely to improve, okay, though very gradually, not in a big way. But more importantly, the earnings growth, corporate earnings growth has been pretty sluggish for the last 3 years. And we expect a turnaround that to happen next year, driven by lower interest rates, driven by pickup in the rural growth, and also some of the sectors which were dragging, like banking and financials, pharma, okay, where we see some recovery going forward. So I think we are looking at markets to deliver returns of somewhere between around 12 to 15% in that range over the next 3 years, or 12 to 13% in that range. And and as I mentioned earlier, the fund has delivered excess return over the market. I think going forward, I think one can assume it can deliver 3 to 4% higher return than the market. So I think that's the range where I think one can expect the fund to deliver. Obviously, in equity investing there is always the element of risk and downside, which we have seen in the past. So that volatility would be there, but I think it would be, I think, realistic to expect returns to be somewhere in the mid-teens over the next 3 years.
Okay. And what happens if one decides to withdraw funds, partial funds, before the end of this 3-year lock-in period?
So if he decides to withdraw, then I think whatever the tax benefit which he has, first of all, I don't think you can withdraw. Okay, the investor, there's a lock-in period which is there. So the investor cannot withdraw from this fund. He won't be allowed to do that because he already taken the benefit of uh, a tax on this when he's invested in his statement. So he can't withdraw from this fund. So to that extent, one has to take that into consideration when one is investing, that there is going to be a 3-year lock-in which you will have to commit to while investing in this fund. So that's why we say that only a part of your allocation which you're investing in equity should be in this fund, which you should do, and which we are very clear that you wouldn't require that money for the next 3 years or so.
Right, right. So again, relating to this, what would be better if I would invest a lump sum amount, or should I do SIPs in ELSS funds? As in,
While normally investors tend to do their tax planning at the fag end of the fiscal year, and that's why they end up putting in a lump sum manner. But I think the ideal way to approach is that just like investing into any mutual fund, we advise to go through the SIP route because there is volatility in the market. The fund will also be subject to that volatility. It will be prudent to invest through the SIP route regularly, I think, throughout the year rather than doing it in a lump sum manner in the fag end of the year.
right, right.
Because the experience,
And how do ELSS funds stack up against ETFs? I mean, a lot of people have asked this query as well.
yeah. So the ETFs are essentially following the benchmark, right? So they are passively managed funds trying to mirror the benchmark. Obviously, the expense ratio there is lower in a diversity in the actively managed fund like the tax relief. The expense ratio is higher, but despite the higher expense ratio, we have seen because of the active fund management and the portfolio manager's ability to really pick the right stocks, do the right allocation across sectors. been able to generate outperformance vis-a-vis the benchmark, which is BSE 200 in this case. Historically, we have given outperformance of around 4 to 5% or so. So I think it's realistic to assume that the fund will continue to give around, say, on average around 3% outperformance, or even more, depending on the, but on average, that kind of outperformance vis-a-vis the benchmark post expenses. So essentially, ETF, which is just mimicking the benchmark, will give returns in line with the benchmark, but an actively managed fund can give uh, better, slightly higher returns. So I think ranging from around say around 2 to 4% at least in that range. Or if you take a 3-year time frame, I mean 1 year the returns or performance can vary, but over a 3-year, I think that's the kind of extra returns the fund can deliver over an ETF.
Right. So one last question from our viewers. The question is, what's the difference between ELSS and ELSS growth funds and dividend funds, right?
So the underlying the fund is the same, really. The underlying fund management is the same. It's just that in a dividend option, the investors are paid out dividend on a, say, in our case, in after every 6 months. So whatever gains are there in the fund, part of that is paid out by way of a dividend. And as you know, dividends are tax-free at the hands of the investor. And we have a policy on terms of paying out dividend. Normally, we target to pay, say, around 2 percentage points higher than the 1-year FD rate, which I think is a good return for somebody looking at regular income to take care of his regular needs. In the growth option, essentially, there is no payout. So whatever returns which are generated are reinvested, and you get a compounding of that, okay, whenever you redeem those units. So you'll find a difference between the NAV of a growth plan and a dividend plan. So the dividend plan NAV, okay, would be much lower than the growth plan NAV, but that is because the investors had taken out money by way of dividend at regular intervals. So that's the only, in terms of the actual return, the adjusted returns, if the dividend was reinvested back by the investor into the fund, then the returns of that fund and the growth plan would be similar. There should not be a difference.
Right. So I said that was the last question, but we have another one last question from our users. So the question is, so this lock-in period of 3 years for SIPs, how is it this calculated? Is it calculated from the date of investment, the first date of investment, or is it calculated for each SIP, each investment?
Yeah, so it will be for each. Okay, each investments it will be looked at. So whenever that matures, okay, accordingly he can redeem that. So each separate investments of that SIP will be treated separately, and as they mature, go out of the lock-in period, those will be, I mean, uh, encumbered. I mean, there won't be any kind of restrictions in terms of withdrawal whenever the investors want to do so. It's not from the data starting of the SIP.
Right. Okay. Thank you, Mahesh. Now I'll. This was a really nice presentation by you. A lot of information. You and I've learned quite a lot, right? And we are quite sure that all of our viewers have got something to take away from this, right? We've had more than 600 viewers today, and I'm pretty sure everybody has got something to take away from this. So I'll be passing on the mic to Faisal from our team here, who will be doing a short demo of the mutual fund, Zerodha mutual fund platform, right?
Sure.
Thank
Thank
you,
you.
Mahesh. Thank you so much.
Thank you. It's a pleasure. Bye.
Bye.
Hi viewers. So this is our mutual funds platform that we had launched last year, and so this is how basically this is the login page. And so once you click on the login icon over here, it'll redirect you to your Kite trading platform login credentials. Just give me a minute. Just enter your Kite login credentials. So basically, you're giving authorization to the MF platform by logging in via your Kite trading platform, and so this is where it redirects. So this is my dashboard. So if I click on this, it leads me to my portfolio, my SIP conditional tab, and my order history. So assuming that you did not have any funds in your portfolio, so you search for any particular fund that you're interested in investing. So you search for Birla Sunlife Tax Relief, and the fund page opens up. So here you can see that you can view the historical data of the NAV for the past 6 years, and you can also see the minimum investment that is required in investing in this particular fund. Yeah. Sorry guys, there was some issue with my screen share, so I'm just logging out and logging in to just show you how it all works all over again. Yeah, so once you log in, so this is your dashboard where you can see the portfolio and the investments that I have made. And this is your SIP conditional tab. So basically, once if you have created an SIP or a conditional order, which I'll explain to you what it is, so it will reflect in your SIP and conditional tab. And your order history will show you all the orders that you have placed, you have deleted, cancelled, redeemed, uh, be it your purchase or redemption orders, everything will be reflecting in your order history. So yeah, so I'll just show you how to place or invest in a particular fund. So you search the particular fund in the search bar, life tax relief. If you're not sure about which fund you want to invest in, so we have an option over here at the bottom of the page called Explore Funds. So if you open up this page, yeah. So if you open up that page, so you can see all the schemes of under different categories for all AMCs, be it equity, debt, liquid, ELSS. So we have categorized it accordingly for any AMC, and you can also just press Control F, and you can probably search for the fund over here itself. So that is one way of searching for the fund if you're not sure which fund you want to invest in. Yeah. So coming back to now, Birla Sunlife Tax Relief 96 growth options. So you have, so as I mentioned, so you can see the historical NAV of the particular fund, and there's also a good option where you can the scheme. So if you click on this compare with other funds, if you want to compare it with some other ELSS scheme, so then you can search for that scheme over here, and this is how it shows up. So hold on. Yeah. So if you open the fund page, so you can see on your right hand side that you have two options. One is the buy and one is SIP. So buy would essentially mean that you are investing it one time, and if you click on this, you can invest it on any particular day. So you are not automating your investments, whether it be weekly, monthly, or fortnightly. That comes under SIP. So here, if you want to invest for one time, or as you say, it's called lump sum. So it will show you the minimum investment amount, and you can mention the amount over here that you want to invest. So if you select conditional order over here, and if you mentioned the NAV as 23, so what happens is that once you click on the buy button, so your order gets placed, but it will not be sent to the AMC because it will only be triggered once the NAV value of this particular scheme it goes below 23. So in case you don't want to do that, if you want to invest or if you want to get the particular day's NAV on which you're placing the order, so you can just mention the amount and click on buy, and this is the next screen. So you click on confirm and invest. So the cutoff time for your purchase orders or any order, even if it's redemption, so it's 1:30 p.m. So if you place your order before 1:30 p.m., for example, if you place it today before 1:30 p.m., so your order will be processed today, and you will receive the allotment of the units by tomorrow, and you will receive the NAV of today, which is released by the AMC after 9 p.m. Okay, so once you click on dashboard, so now you can see. So this is how it will show. You'll have a pending order window, and if you want, you can even delete it. But if you want to delete your particular order, so you should delete it before 1:30 p.m. of that particular day. So this is about your lump sum investment. That is a one-time order. So coming to SIP, I'll just show you how it works. Yeah. So now if you click on the SIP tab over here, these are the options that you can see on the screen. So this is the initial investment amount would be the first amount that would get debited as soon as you click on the start SIP tab. So this will be the order that will be placed immediately, and you can select the frequency, which is weekly, 15 days, monthly. In the monthly, we have also provided options that you can select the particular dates at which you want the installment amount to be debited, and here you can mention the amount that you want to invest on the particular date of investment installment. And so here, once you come total installments, there is one option called until cancel. So if you select this option, so your SIP installments will go on for infinity, and unless you delete it or unless you cancel it from your end. But if you don't select this and if you mention 10, so that means you have automated your SIP investments for 10 installments. So basically, what is happening now? If I click on Start SIP, confirm and invest, dashboard. So as I mentioned, your first order. So since this is uh, your investment in the scheme, this is via SIP for the first time. So that's why you can see this 500 rupees. This is your first order which is being placed. Now, if you go to your SIP and conditional tab, so you can see the details of your SIP, start date, amount, monthly, installments. Since I mentioned the number of installments and I did not select until cancel, so that's why it's showing 0 by 10. So on the 8th of March, once this order is placed for 5,000, so then it will show as 1/10. So the good feature on our platform for SIP is also that you can edit your SIP at any point of time. You can even pause your SIP, so the amounts will not be debited from your account, and you can unplay it at any point of time. You can even delete this SIP. So if I delete this SIP, So this SIP mechanism which I have created, it will not be there anymore. Yeah, so this is basically how it works on a platform. It's pretty much simple. And so a couple of important things that the users or the new users would have, the queries. So one thing is that the amount is not going to be debited from your bank account. It is going to be debited from your trading account. So suppose if you have placed the order today before 1:30 p.m. For today's NAV, so your order will be processed, and then we will check your trading account balance at the end of the day, and then we will debit the amount. So yeah, that's pretty much about it. And if you have any queries, you can write to us at support@zero.com, and you can also look up this FAQ section, because we have put up a lot of questions related to our platform, and some information related to uh, common terminologies like exit load and other stuff. So yeah, guys. So thank you for tuning into this webinar, and so we'll be conducting a lot of webinars on our YouTube channel, and there'll be a couple of these mutual fund talks once every month. So if there's any queries uh, related to the RMF platform or the webinar in general, so you can write to us now.
Okay, so Faisal, we have a query. That says what happens if the account balance is lower than the actual SIP or investment amount. What do we do in such cases?
Yeah, so if you have placed the order today before, as I mentioned, before 1:30 p.m. and you do not have the amount in your trading account, so you can transfer the amount before 4 or 5 p.m. before our trade process, so that after the trade process, the amount reflects in the Q ledger balance. But yes, if you have not transferred the amount and if you have still placed the order for today's NAV, so then your order will be rejected for tomorrow.
So I guess we don't have any other queries as such. So
Yeah.
we take leave of you guys now.
Yeah.
You're a great audience. So yeah, have a good evening.